Hey, thanks for joining another discussion video. I have here in front of you the NASDAQ 100, which is the 100 largest NASDAQ stocks. They're usually tech-related stocks. I could easily just pull up the SP 500 and it would be the same story. But I was talking to a friend and he was not as concerned as I would have expected him. And it made me want to do this video about how do we know where the market is relative to value, or how do we know when the market is expensive? It's really hard to tell because for the last 12 years the market hasn't really come down more than 50%. The worst we had was when the health crisis brought the market down 30% and maybe 45% on the indices, but it just exploded up, as you can see by this last explosion. So I want to do a video on price to sales. This video will just be price to sales and what information we can gather from that information, from that metric. All right, this is the price to sales ratio of the S&P 500. As it says right here, we're talking about the S&P 500 now, which is the 500 largest stocks in the S&P index. The price to sales ratio, it's the stock prices divided by the sales ratio. So sales is reflected down here. I'm going to scoot it down so you can see the years. So what it says essentially is when you're buying the index compared to the sales, what's that ratio? When the market is cheap, as we can see down here, because in 2008, 2009, the market was very cheap. What was that ratio? It was below 1. So a safe assumption would be that when the market is down, the price to sales ratio is also low. The opposite must also be true. When the market is high or relatively high, based on the previous price action, the ratio must be high. So now let's look at the whole picture. If in 2008, 2009, a price to sales ratio of 1 was a cheap valuation, what does that imply for the current number at 3, over 3? I would have to think that this market is not cheap. So if we jump back to like the NASDAQ price or the S&P price, if you look, the market at the bottom in 2009 was under 800, 700, right around there. I think the bottom was like 668, something like that. So it's under 700, and right now it's at 4,500. Okay, if we look back to the ratio, you're getting a higher value, a higher cost for the same sales. Actually, not the same sales. The sales keep growing, but the ratio is now 3 to 1. So right here at the bottom, it was closer to 1 to 1. Here you're paying 3 times more price. 3 times more price for the sales at the time. And I'm going to pull up another longer term ratio as well. Okay, this is the S&P price to sales ratio, but over, was that 60, 70 years? Now it's not up to date, so it doesn't have the continuation from up to 2021, but it does show us the longer term picture. In the 1980s, apparently that was when we had the last stagflation and inflation problems, and a lot of the premium in stocks was not there because gold was really expensive, inflation and interest rates were really high. The dollar was in crisis. So if you look at that valuation, we had a valuation under 0.50, 0.50. And if you look here, 2008, 2009, we almost got down that low. So this range below 1 is a good indicator for us to realize, hey, maybe stocks are a deal. Maybe this is somewhere where we could start buying stocks. Now, on the other side, if we look at the biggest bubble in history, which was the dot-com bubble, prices were at 2 times sales. And in the last 70 years, when prices were elevated, valuations were elevated. The 1960 to 65, the highest was around almost 1.5, so 1.4 value or price per sales. Given that information, we know when price is low, the price to sales is low. When stocks are high, the price to sales is high. Okay? So what does that mean for current valuations? Let's look. Going back to the data that went back 70 years, we know that below 1 is good, above 1 is bad. So below 1 was good in 2008, 2009. And look how high we are now. We're up to 3. 3 is an insane number now. 3 times sales. Very risky, I would say. Given the data that I just showed earlier, we'd rarely get up to 2 times sales. We rarely get up there, and we're at 3. So that's very concerning. So we either have to see a huge growth in sales, we got to see a huge jump in sales, or the valuation is too high, which could be because of interest rates. Let's look at another metric, because the interest rates and the inflation data is a factor. Let's look at something that kind of gives us some clarity as well. This is the last piece that I want to share is the same chart that I just showed earlier with price to sales for the last, maybe it was 15 years. I want to show also a different ratio, which is the SP 500 divided by gold. And notice that this coincides and it confirms that the discount rate or the people are overvaluing stocks compared to sales and also to gold. It was a very similar ratio. The S&P to gold ratio, or the S&P in terms of gold, was below 1, just like price to sales. And the S&P in terms of gold, instead of dollars, was over 2, just like price to sales. So this is a second layer of valuation. So either gold is too cheap, or the dollar is too cheap, or stocks are too expensive, or a combination of both, or all 3. That's my takeaway from this data, that this number 3.2 price to sales, or 3.12, whatever we are, is a little high, or a lot of high, depending on how you look at it. So I would be concerned. I would want to be careful. I would not want to put on big positions, and I would want to trim positions given this data. Okay? And lastly, let's just look back at this S&P chart one more time. Now that we've seen what it meant to be down here in the red at the valuation of below 1 times sales, that was a really good deal. And then where we are right now, on average, the S&P is being valued at 3 times sales. So it makes sense. If the stock market is 3 times as expensive as it used to be, that would mean that a 2 times sales would be a 33% decline, which, what is that? Back to the old prices before the health crisis. And then if it goes even lower, what's 1 times sales? That would be a 66% decline, maybe around 2,000 on the S&P. So that's why it seems very risky. The market got really high because interest rates went down and valuations went up and people just kept buying it. But if the market corrects to a normal range, that implies that somewhere between 3,000 and 2,000 on the S&P could happen. Or the other possibility is that we just stay here for a long time, and that could also happen. But I would still not expect for huge moves for a couple of years until we work through those valuations. That's the big takeaway, and that's why I'm making this video. I hope you enjoy it. If you have any questions, send them to me. This is not advice. This is just discussion for education. Take care.